Thank you so much for joining this webinar. During this webinar, we will be presenting the key findings of the Global Off-Grid Solar Market Report, and the period we'll be covering is July to December of 2023. So the agenda for this webinar today, I will introduce the panelists, and then each of the panelists will share key insights from the report. And then we will announce a winner for the ticket raffle that we did. And lastly, we will take Q&A. So on to the panelists. My name is Patricia Njeri. I'm the Membership Engagement Manager at GOGLA. Then we have Oliver Reynolds. Oliver is the Senior Manager, Market Insights and Data at GOGLA. We have Andrew Kent. Andrew is an Energy Access Consultant at ESMAP. Then we have Joseph Thomas. Joseph is the Evaluation Manager at Energy Saving Trust. And last but not least, we have Sienna Hacker. She's the Senior Associate at CLASP. And so my colleague Oliver will launch a poll shortly. Kindly, we request your participation in it. Please select the description which best fits your organization. So keep this on for a few seconds. Kindly do submit your answer. And as you do that, just 1 or 2 housekeeping rules. Kindly keep yourself muted during the course of this webinar. As I mentioned, we will address any Q&A questions at the end of it. So feel free to type in your questions in the Q&A box or in the chat box. And of course, if you feel bold enough, you can also raise your hand at the end of the session, and we will, sorry, I forgot to turn on my video, and we'll address any questions that you may have. All right. Oliver, are you done with the poll?
Hey, yes, sorry, I couldn't find my unmute button. Yeah, okay. We're done with the poll, which I accidentally closed, but I think the most common response in the poll was companies selling off-grid solar products. But I see we also have a mix of other stakeholders from the sector. But I guess we can start getting into the results of the report, and I'll kick us off by trying to put the numbers in context a bit, because in these reports we tend to focus on, okay, what's been, because we publish them every 6 months, we tend to focus on, okay, what's happened in the last 6 months or 12 months. And you can, from what you can see on this chart, well, 2023 has seen sales decrease compared to 2022, but I think it's important to look at that in a broader context, which saw kind of record growth in 2018, 2019 to a first kind of pre-COVID peak volume of sales of 8.5 million. From there, the industry, as the world economy kind of hit the pause button, the industry took a significant hit, basically knocking almost 25% of that top volume off into 2020. And we then saw this at first slow and then accelerated recovery trend between 2020 and 2022. So yeah, we do see a slowdown in this recovery in 2023, which was expected already when we received data for the first half of the year and saw that sales had plateaued. But yeah, we knew the context had been particularly tough. You could argue that it has been for the past 4 years. But 2023, high inflation, sustained inflation that already started in 2022, depreciation of a lot of local currencies versus the USD, and in some cases in key markets like Nigeria or Malawi, devaluations, and compounded with all that, a bit of a slowdown in access to finance, was a bit of a funding winter over the last 18 to 24 months, which have really kind of put a spanner in the works for a lot of the companies operating in our sector. It's interesting to see, though, that, I mean, despite all this, there's quite a limited drop in sales between 22 and 2023. It's only a 6% fall, which showing clear signs of resilience. Additionally, I should highlight that because in our data and in our reports, we focus on what we call manufacturer sales, so sales of companies that are shipping these products to the markets or that are vertically integrated. Our data tends to be a bit choppier, let's say, in a way, than what's happening in the field. So it is possible that we have some insights from distributors that this trend on a local level might be a slightly more evened out. But nonetheless, the context, the fact that the industry has struggled a bit more in 2023 remains true. And maybe I think most key is that, and my colleagues will help us dig deeper into these insights and make sense of the data. But maybe one reminder is that a lot of what we work towards is universal access and SDG 7, and that to be able to reach that, we are going to need to not only continue reaching new customers, but also replace products that are reaching their end of life. And I think that's the perfect moment for me to hand over to Andrew, who's going to talk us a bit more about what these trends that we see here have meant in terms of energy access.
Yeah, I think that was a pretty good segue into that because you know, we often get excited about sales and connections, but we also want people to stay electrified. And unless customers have a maintenance plan or buy replacement parts or buy a new solar energy kit, they'll lose access to electricity when the system runs out of juice. So this shows what we're talking about here. So for anyone who's new to this data, because it sometimes takes a little bit of time to wrap your head around, the blue box and the blue line, the 463 million, that's everyone who's ever bought a solar kit. And then the orange is people who we estimate still have one that works. And that's done by removing from the cumulative sales any products that are older than the estimated lifespan of the system. And that's probably a bit of a conservative estimate. We know that customers do buy maintenance plans, they do get repairs. So the actual number is likely to be higher than that 118 million that you see there. But I think what's interesting is that, you know, we might say that this is due to COVID, but actually when you look at even before COVID, 2019, this had pretty much already flatlined in terms of the people who still have access to improved energy. Companies are making sales at a pretty steady rate, you know, for COVID, throughout COVID, and now, but that's only fast enough to replace the systems that are dropping out as they reach the end of their lifetimes. And I think the important point there is that that's probably a function not just of companies, but of math. Because unless companies can increase not only their sales, but the rate of sales, this gap is always going to get worse. And I think this is both a challenge and an opportunity, both for companies and donors and development partners. For companies, I think what this really highlights is the challenge is that we're not selling enough to actually grow the number of people who have access, which we already said. But I think there's a big opportunity there as well if companies have the right systems to identify people who are reaching the end of that lifetime. They can go back and actually sell a maintenance plan or spare parts or a new kit. And that's an area that I think companies really need to focus on. And it's probably an easier sale too, because you don't need to send a sales agent to get a new customer, and you've already got somebody who's used to your product. And then as donors and development partners, I think it tells us something about what we measure and what we incentivize in our programs. You know, we often like to look at connections and new connections especially. But if we're only incentivizing the connection, you know, we're giving an RBF for the sale, only incentivizing temporary electricity access. So we probably want to start measuring things that get at the maintenance problem and designing our programs to reward that as well. So that's probably the main thing that I have to say on that, and we can move to the next slide.
Brilliant. Thanks, Andrew. Yeah, hi, everyone. So Sienna and I will be presenting insights into key appliance sales in the second half of 2023. I should probably say here that when we're talking about the key off-grid solar appliances, we're referring to the 4 appliances that you can see in the top of the slide. So that's TVs, fans, refrigerators, and solar water pumps. So yeah, my first insight there will be global highlights for each of the key appliances. So overall, the key appliances in 2023 decreased compared to 2022, but they're actually the second highest sales they've been since GOGLA has been reporting data. Yeah, and as you can see in the table on the right-hand side of the slide, there were more than 769,000 key appliance sales in the second half of 2023, which is a decrease of 24% compared to the first half of 2023. And one reason for this decline is primarily this seasonal variation of fan sales in Pakistan. So this is essentially where distributors bulk buy their products at the beginning of the year so that they're prepared for high demand as buyers look to purchase fans ready for the warmer seasons. And so since fan sales represent such a large portion of the key appliance sales data, their reduced sales has caused a decline in overall global sales. But I think it is worth mentioning here that although the total number of appliance sales decreased this round compared to the first half of 2023 because of fan sales, the sales of the 3 other key appliances were actually quite stable, and they increased by a few percentage points. But then if we compare the second half of 2023 with the second half of 2022, so that we're comparing the same seasons, and you can see that on the right-hand column of the table, sales have increased by 20%. And as you can see, this is primarily driven by fan sales, which have increased by 40%. Yeah, so for key appliance sales, the other 3, they've decreased, and that's quite significant for refrigeration units and solar water pumps. And they've both dropped by about a quarter since the second half of 2022. But if we drill down into each of the key appliance sales in the second half of 2023, the pie chart on the left shows the proportion that each appliance contributes to. And despite being impacted by seasonality, fans are by far the highest sold appliance, with 70% of key appliance sales, and there's 536,000 fans sold. Then TVs make up 28% of global total key appliance sales, and there were 218,000 TV sales in the second half of 2023. And this is a 1% increase compared to the first half of 2023, but a 7% decrease compared to the second half of 2022. And the vast majority of TV sales are in sub-Saharan Africa, where they're bundled with solar home systems 93% of the time, and 98% were sold with PAYGO. And then solar water pumps are the next largest portion of global sales, with around 11,700 sales in the second half of 2023, which is a 22% increase on the first half of the year. And in total, 75% of global solar water pump sales were bundled with a power source. And then refrigeration sales, they make up the smallest segment of key appliance sales, with just under 3,500 units sold. That's a 4% increase compared to the first half of 2023. But as I mentioned earlier, it's a 25% lower than the second half of 2022. And yeah, I'll now pass you on to Sienna for her first insight.
Thanks, Joseph. Yeah, so looking at the trends that we're seeing and how sales are actually being made, whether it be via PAYGO or cash, we see that sales by either mechanism declined, reflecting that slight decrease in sales overall that Joseph really just took us through. However, it's interesting to see here that the decrease in PAYGO is relatively small at just 5% compared to a 38% decrease in cash sales. When we look at that decrease in cash sales, it's really led by the decline in fan sales in Pakistan, which, again, as we just talked about, is an expected result of the seasonal fluctuation in fan sales in the Pakistan market. And that really also reflects, right, that fans are the largest, have the largest sales of any of the key appliances, and that the biggest market is in South Asia and Pakistan, right? And that leads us to then see that, you know, the market there is mostly operating in cash, as opposed to sub-Saharan Africa, where the penetration of PAYGO is much higher. So when we look at, again, that decline in cash sales, that's really reflective of the fact that the South Asian market is having that slight decrease in fan sales. Again, it's seasonally expected, and those sales are being conducted in cash. Another key difference between the South Asian and sub-Saharan African regions is that fans are typically sold separately from a power source in South Asia, whereas in Sub-Saharan Africa, they're more often bundled with a kit, and as mentioned, sold via pay-go. And so while we've historically seen, as I mentioned, that pay-go and this bundling is more common in Sub-Saharan Africa, it's interesting for us to note that in recent years in West Africa, cash sales are actually starting to outpace pay-go sales. So we'll definitely want to pay attention to this moving forward and see how the market will continue to evolve. And yeah, now I'll pass it, I think, to Andrew.
Yeah, so this is another similar sort of graph, but this is looking at, instead of appliances, at solar energy kits. So again, it's showing pay-as-you-go versus cash sales. And I think the big trend is that although both have decreased slightly, the decrease has been quite a lot bigger for pay-as-you-go. And just to orient you to this a little bit also is that the reason why those bottom two lines don't add up to the top is because this is just a selection. We've just shown two regions out of all of them. We're not showing South Asia or Southern or Central Africa, for example. And I think what this shows is a bit of a mixed bag. You know, it's encouraging to see East Africa continuing to grow pay-as-you-go, although a little bit concerning to see West Africa dropping as well as just the overall. But again, as Oliver said, putting it in context, this is still, you know, the second or third best month that we've ever had. It's just not as high as the peak from a year ago. But it is maybe somewhat counterintuitive to see pay-go sales going down by more than cash, because in bad economic times, you might think that pay in installments would really help people and people would shift away from cash. So a few hypotheses we've had for why that might be. I think the biggest one is that pay-as-you-go products might be more impacted by some of the recent trends going on in the market. So for example, one would be RBF expiry. So in early 2023, the RBF in Nigeria finished, and that was mainly being used to support pay-as-you-go products. So no surprise that you see a big drop in West Africa, which is pretty much just Nigeria. The second is currency depreciation. We all know that these countries are struggling against the dollar, currencies are going down. That's really going to impact companies' ability to not only raise financing, but also to extend out the payment plans. Companies, to offset currency risk, have to shorten their payment plans. That pushes the daily or monthly payment rates up, which might make those less affordable for customers. And the third is working capital constraints. The pay-as-you-go products tend to be more expensive, need more cash upfront for companies to buy them and import them. And as companies face difficulties raising capital, raising financing, it could be having a higher impact on those more expensive products, and they don't have as many available to sell. So that's it for that one. I think back to, I think, Oliver, is it you?
It is me. Yeah, so for my second insight, kind of an example of why you should also dig into the report to look at the country level trends, because obviously this is a webinar, we're sharing 8 insights, we're focusing on the big picture and the deeper trends in the market, but to be able to understand what's happening in East Africa, West Africa, and so on, you really need to look at the individual markets. I think you've understood from Andrew and Sienna's comments that actually looking at West Africa and looking at Nigeria will be pretty similar, Nigeria being the dominating market now in that region. But the trends in other markets are quite different from what's happening in Nigeria. And if we look at East Africa, where we have more kind of mature or emerging markets in the off-grid sector, there can be quite significant differences based on a variety of factors. So I chose to focus on 2 countries here that have seen fairly different trends over the last 3 years. So on the left-hand side, you have Uganda, a slightly more mature market, not as mature as, let's say, Kenya. And then Malawi, which is a slightly more nascent market or emerging market. And I think these 2 countries kind of exemplify the difference, where the East Africa regional trends can tend to reflect the situation in some of the larger markets like Kenya and Uganda, and hide some of what's happening in other smaller markets. So I think both from what my colleague said and what I said in the beginning, understand that the context has been, like the broader macroeconomic context has been affecting the sector quite a bit. And actually, it's interesting to see that in Uganda, we saw economic growth in 2023, 5% economic growth, showing a strong signs of kind of a rebound in the economy. Inflation was also brought under relative control in the first half of the year. And there's quite a lot of support for the industry in that market, both because there's support from the Ugandan ministry in kind of trying to form a favorable context for the sector to participate as part of the electrification plans. But there's also quite a few programmatic interventions that are supporting the market in that sector. Notably the NDEV Last Mile RBF, which is run by the Private Sector Foundation of Uganda. A demand side subsidy also launched by NDEV, the Beyond Grid Fund for Africa, which has now been dispersing in Uganda for a couple of years, and which will be running until 2026. And obviously, it won't have affected the trends yet, or at least to a limited extent, but the Uganda Energy Access Scale-up project from the World Bank, which is implemented by UECCC, should start really showing its effect in 2024. But obviously these kind of large programs on the horizon also bring a certain confidence to operators in that market. So it could have already kind of generated a bit of a of enthusiasm, let's say, for the Ugandan market. And finally, even though they're not represented in this graph because we're focusing on solar energy kits here, I should also mention that Uganda is also benefiting from support for the productive use sector with the productive use appliance financing facility, and also with the SEFA program, so the smallholder energy for smallholder farmer program, which are so quite a lot, as you can see, of programmatic intervention in this market, plus this kind of slightly more positive general economic context in the country, seem to be some of the underlying factors which can explain this kind of continued recovery growth in Uganda, which we don't see in all other markets in the region. And one of those markets where we've seen kind of strong growth immediately after COVID in 2021 and 2022, and that took a hit in 2023 is Malawi. It's not the only market. We saw similar trends in other nascent markets such as Mozambique or Madagascar, so kind of these slightly more southeastern African markets, which were doing really, really well in 21 and 22, that all kind of took a hit in 2023 for a variety of factors. And I'll just focus on Malawi here. Malawi the Malian government has devaluated the currency in several installments, but overall the total devaluation is close to 45%, which, as Andrew made a point before on how that affects companies' ability to operate and how it forced them to adjust their payment models for PAYGO. But obviously, it's also in many cases rapid adjustments to pricing, which might make these products less affordable to end users. Then finally, one of the factors, I mean, in previous reports, we'd highlighted that in Malawi in particular, there was a growing demand for off-grid solar as kind of a backup solution, especially after one of the main power stations in the country had been damaged by Cyclone Anna in 2022. Our understanding is that thanks to international support, that, and it's a good thing, that dam is now back online and generating power to the grid, which might also have slowed down that demand for off-grid solar as a backup. The last thing that kind of compounds with all of this is that from a programmatic intervention standpoint, Malawi's kind of gone through a transition year where some of the support programs that were supporting the market in 21, 22 kind of hit a pause, or we were transitioning to new programs. And we were quite curious to see what happens in 2024 for this market, notably with the World Bank funded Win-Win-Way Fund, which has been announced, but for which, I mean, the dispersal is starting a bit later than originally expected. So hopefully we see a return to growth, or at least some positive signs in that market in 2024. But yeah, all this to say, please dig into the report for the country level insights so that you can go a bit deeper than this presentation allows us to show. And with this, I'll hand back over to Joe for insights on appliances.
Thanks, Oliver. So I've chosen for my second insight to focus on key appliance sales in East Africa, and I'll also look at Kenya's influence in the region as well. So overall, more than 127,000 key appliance units were sold in East Africa in the second half of 2023. And this is a 1% decrease compared to the first half of 2023, but a 4% increase compared to the second half of 2022. And if we look at each key appliance in East Africa and its change since the past 2 rounds, which you can see in a table on the right-hand side of the slide, we can see that TVs are the most common appliance sold in East Africa, and they represent 78% of total key appliance sales in the region. Both TV and fan sales have slightly declined over the past 12 months. But then if you look at refrigeration units and solar water pumps, on the other hand, they've been showing really good growth. And solar water pumps in particular are a big market in East Africa, and the sales in the region actually make up 77% of global solar water pump sales. And the biggest contributor to sales in East Africa is by far Kenya, which makes up about 58% of the region's key appliance sales. And if you take a look at the chart on the left-hand side, you can see the total volume of key appliance sales in East Africa per round. And that's including Kenya on the left and then excluding Kenya on the right. And if you look at the light blue and green bars on the right of each block, you'll see the sales in 2023. And you can see that without Kenya, appliance sales would have been less than half in East Africa. So why are sales so high in Kenya? This is mainly driven by TV sales. So TV sales make up more than 3/4 of all key appliance sales in Kenya, and they've increased 6% compared to the first half of the year. And one key reason for this increase is the increased number of solar home system sales in Kenya. So 99% of TVs were sold bundled with solar home systems in Kenya, meaning that TV sales tend to follow the trends of solar home system sales quite closely. But other markets in East Africa are not quite as strong and not showing as high appliance sales. There are some expectations, such as Tanzania and Mozambique, who are showing some steady growth, but they're still not really reaching anywhere near the same amount of sales as Kenya. But there is one appliance that kind of bucks this trend, and that's refrigeration units. So refrigeration sales in Kenya dropped by 49% in this round to 275 units. But despite this, refrigeration sales actually grew in East Africa by 21% to over 1,000 units sold. For data confidentiality reasons, I can't actually share the specific countries that are showing good growth, but it's just really interesting to see that appliance sales in East Africa are not entirely reliant on Kenya. But having said that, I do think it's important to note that although there are some small signs of progress, so as you can see in the chart, the appliance sales in 2023 in East African countries, excluding Kenya, has been stronger. There's still a lot of support needed to enable other countries in East Africa to catch up with Kenya. Now I'll pass you on to Sienna for the final insight.
Thanks, all. Yeah, excited to round out and moved from East Africa to West Africa, where we've seen tremendous growth over the past few years. And actually, very interestingly, the region has now overtaken East Africa for total key appliance sales. So sales in West Africa now account for 64% of sub-Saharan African sales. When we look into the data here in the graph there on the bottom left, we see a slight decrease of 5% in overall appliance sales since the first half of 2023. But year over year, we're seeing a 14% increase. So definitely going to keep paying attention to how sales are moving forward, but really promising signs for the region, even in the face of volatility and other market conditions. As with Kenya dominating sales in East Africa, in West Africa, we have Nigeria playing a really outsized role. It's not for no reason. It has the largest population in Africa with roughly 224 million people. So, that's a huge market. And 88% of all appliance sales in West Africa are actually happening in Nigeria. When we look at the breakdown, we actually see that fans are leading the market, followed closely by TVs, but fans really strong performance there. And that's for good reason. The climate can be incredibly hot. I was there last month and the heat wave was very intense. Fans make a huge difference. So very exciting to see Nigeria continuing to lead. But it's important to note that even though we see the strong performance in that individual country, that performance is kind of hiding more nuanced trends in other markets in the region. So when we zoom out and look at sales in the region beyond Nigeria, we see that key appliance sales only grew in Liberia. All other markets stagnated or declined. So it's important for us to consider, right, what is happening in the region without Nigeria's kind of sway and performance there. But yeah, I think that's the end. So I'll pass it back to GOGLA.
Thanks, and thanks everyone. Before we head into Q&A, for the participants in the data collection, kind of as an incentive, we've started raffling tickets for those who share data on time with us. This is the first time we do this, but it's something we want to continue doing in the future, especially rewarding companies that are kind of consistent in their reporting. So we'll share future plans with the companies that participate in the data collection. But we wanted to use this webinar to announce the winners of the first data, let's say, ticket raffle. Unfortunately, I don't think they're actually on the call today, but we'll reach out to them offline. So we randomly selected the winner a few days ago, and the winner is Churchill. So I'm just checking if I can recognize any names in the list of attendees, but I don't think so. If there is someone from Churchill, feel free to send a message in the chat. Yeah, congratulations to them. And if you're interested in joining the data collection in the future, feel free to reach out to me. My email will be on the last slide in this deck. I'll now move us into the Q&A. I see someone actually has their hand up. Usman Badje. Usman, I'm going to guess you're willing to speak, so I'm going to allow you to talk. But if that's not the case, feel free to just remute and send your questions through the chat. Not sure that's working. In the meanwhile, I'll go to some of the questions we've received. So I think we had a couple in the beginning on the first slides we showed, but I think those have been answered. Maybe one question, which I think was in reference to the appliance market, but correct me if I'm wrong. This is a question from Ted Isengingo. The question was, what would the numbers look like in terms of sales in USD? Maybe I can first caveat that by saying that we don't have that in our data. We focus on volumes, but maybe any of the other panelists would care to provide some maybe contextual information around appliance sales pricing. I guess I'll take it. I think maybe, I mean, I'm not sure exactly which slide that referred to. And I think in the key appliances, we do show in parallel or grouped together, or actually aggregated together, fans, TVs, solar water pumps, and refrigeration units. Being able to really paint a clear picture of what that would mean in market value would be quite tricky. I mean, so we know on a per unit basis, fans are definitely the cheapest of these appliances. TVs are a bit more expensive, and then obviously you enter solar water pumps and refrigeration units, the per unit cost is significantly higher, and a significantly higher barrier for adoption. But you also have to add to that the fact that in some cases TVs and fans might be sold as part of PAYGO. So do you factor in the cost of financing into if you factor in the cost of financing into those appliances compared to those so cash, then you have a slightly different picture as well. So I'm not sure we can give a really clear answer to your question, but for sure, like the contribution of the different appliances in volumes and in value would be quite different if we were able to showcase those side by side. think we have a comment here, but it's interested to hear if someone else wants to react to this. I think it was especially regarding pay-as-you-go. So we have a comment from Gang Zhang saying that Nigeria's depreciation, exchange rate depreciation, is a real challenge to the sustainability of the pay-go model. And I guess maybe a question more generally around exchange rates and the pay-go model. I was wondering, Andrew, if you care to come in and share your thoughts on this.
Yeah, I mean, it's a really fair point, and I think that if currency did continue to depreciate at such massive rates, it would make, I never want to say impossible, but it would make the pay-as-you-go model really hard. And companies would really have to look at shortening their pay plans to even 6 months or 12 months, because if you're losing 20, 30, 40% a year, there's just nothing you can do about that. So yeah, I mean, I never want to say something's impossible, but I think currency is a real issue and something that's going to be really hard to manage. So sorry to have kind of that not a very uplifting take.
Yeah, maybe I can jump in to double down on the maybe more pessimistic outlook, but from recently being in Nigeria and Sierra Leone and speaking to a number of companies in the sector, I'm already seeing companies change their pay-go offerings. Like you said, Andrew, shortening the window or really emphasizing customers who can pay in cash, especially for larger appliances where, in the region, for a variety of factors, we've seen, at least in the companies that I've been speaking with, an insufficient amount of supply of appliances for the demand that they're seeing. I've seen companies really prioritize consumers who can pay up front. And I think it's also important, as we see like the way that companies are able to operate in the future. It's not just this currency volatility is not just an issue for consumers and pay-go, but also for the way that companies are able to operate themselves, able to repay their loans, et cetera. So yeah, really concerning, but hopeful that some stability comes to the market soon.
Thanks, both. Maybe another question back to you is, I mean, obviously, one of the solutions that PayGo brought is ability to tackle the affordability challenge. If you take PayGo, or you say PayGo is less efficient or less sustainable in this when we have these trends in foreign exchange, are there other options that would enable companies to continue providing kind of solutions for affordability outside of PayGo, especially when we talk about larger appliances, which, I mean, have such a higher affordability barrier?
Yeah, it's a good question, Oliver. And, maybe I'll leave Andrew any thoughts that you have about what the companies are able to do. But right now, I think that many are looking to kind of like external support, right? So I help run the productive use appliance financing facility, and we offer procurement subsidies to companies to help lower, potentially it's not mandated, but they can lower the price for consumers and pass those subsidies on. I also support with Charm Impact, the CECIL supporting early stage local entrepreneurs program. And we offer, as part of that, in addition to financing for companies, we also offer a synthetic local currency hedge to, help protect companies against this currency volatility. That's more for repayment of loans for to public or private financiers. But yeah, I think, it really speaks to the need of programs like this to offer this kind of support when we see really challenging market conditions. Companies are doing their best. They're doing everything right that they can. But it's tough out there. So yeah, but Andrew, any other thoughts from you?
Yeah, I mean, I'll echo on subsidies. I think there's just no getting around the fact that subsidies are going to be needed to help offset some of these risks. And it's one of the nice things about not just the RBF, but any sort of support that gets money to companies upfront or mostly upfront, because then they can go ahead and pay back some or most of their loans, and that really blunts some of the currency risk. Beyond that, I guess I could think of modular products so that you could sort of, I don't know if these exist on the level that would make this truly possible, but you could sort of imagine a build your solar kit over time, and you start with like a 5 watt or 7 watt system, and then you keep adding to it. But I that's quite technical, so I'd have to see more details to know if that would work.
Thanks both. I see, Sienna, you shared the link in the chat, but I was wondering if you'd be also able to share a bit more in response to Candice's email asking if you could explain a bit about the synthetic finance hedge, given how much time we've spent on currency devaluation. I think it's timely.
Yeah, happy to explain a little bit more and happy to have any additional conversations offline about this. This is a relatively new program that's been launched in the past year, and we are currently working with 10 companies that are all locally owned, mostly in East Africa. Charm Impact, as I mentioned, is taking the lead on this, but Clasp and myself were supporting. And it's essentially it's not not always super exciting for donors, but here's what we're pitching. We are going to lose money to help companies. And by that, I mean, we are going to guarantee companies a certain rate. And if if inflation or currency depreciation, whatever, devalues the currency to a certain point, we will allow them to repay the loan or help them repay their loan to another financier at the rate that's agreed upon. And the program will absorb that difference. And so that's basically all that's meant by, I guess, a kind of jargony synthetic currency hedge, is basically that we're just helping you fix the rate that you already had to make sure that you're not exposed to that volatility. And yeah, and I guess I'll just say too, like, we've been really, really excited to see the kind of impact that it's had. I mean, everybody knows that this market is challenging, but I think of the 10 companies that we've been supporting in this first phase, 3 probably would have had to default on their loans had they not had this support.
Excellent. Thanks a lot for sharing that, Sienna. I think I see another question, which, if I understand correctly, is not just about the kind of energy access at like lower tiers, but also do you also observe the general trend, especially in the middle class, that need more reliable supply of electricity and go for, say, 5 kilowatt hour systems? So I can say that this is not something that we currently track in our data, where we focus very much on smaller, entirely DC systems, up to a few 100 watt. Some of our members and the companies that report to us also have these kind of larger products, which are equipped with inverters and are able to power AC products, either as a backup, also sometimes as a primary source of energy. But we don't have like hard data to back it, but we know from speaking to the companies in our space that yes, there is this growing need, and there's a growing market for these kind of larger solar operated solutions as a backup, or to power productive appliances and so on. And we see more and more players that have been active in the solar arm system space also move into this space, also because, as you pointed out, it's generally more middle class customers and can become quite a good source of let's say diversification of their product portfolio, to have these products that are reaching customers that are less risky to reach. So yeah, I think I'll stop at that. But yeah, wondering if there's anyone else that wants to comment on the trend for these kind of larger AC DC power systems that I mean, we see more and more of the GOGLA members and GOGLA affiliates sell, whether backup packs or power banks, all the way to large kind of integrated, for lack of a better word, solar generators.
I mean, I would imagine that some of it is the like you said, the customers are just, it's easier to make money. So people need to diversify and find some things that they can sell to people who have money so that they can continue serving the customers that they want to long term.
Thanks, Andrew. We're reaching the end of the questions. There's a few of them that we can probably answer online, which are specific around like kind of methodology, what's included in the report. So I suggest we have a quick closing poll, which I'll launch immediately. And then we'll provide you with a few links to reach the report and other resources. But let me first launch that second poll briefly, give you a few seconds, and then we can close off. Thank you for those who are sticking through, despite the fact that I've said that we're closing off after the poll and who are still answering. I'll give a few more seconds as there's still people sharing their feedback. But yeah, I'll maybe say, or use this time to also thank you to the other panelists, to Patricia for having kicked this off, and thanks a lot, Joe, Andrew, Sienna, for some of you once again taking part in this webinar. Andrew, it was your first time. And yeah, we look forward to sharing more insights in a few months once we get the 2024 data, and hopefully with all the exciting stuff that's happening in the sector and all these big programs that are being kicked off. We will see. We hope to see some changes in the trends compared to what we saw in 2023. And yeah, thanks again everyone for attending. And I'll just show this briefly. So here is you can visit the GOGLA website to find the latest edition of the report. If you have any questions or you want to dig into how we calculate impact, that's also available on our website, and the data, kind of the aggregated results for the industry, are in the report, what Andrew shared, but also other indicators. And if you have any interest in further insights, you can reach out to myself or the info@gogla.org email, and you'll be redirected to me or one of my colleagues. So once again, thanks a lot, everyone. It was a pleasure to share this webinar, and until next time.